we're here with Jason Birnbaum from Bow Properties, and Jason, can you tell me a little bit about your family's company?
Absolutely. So Bow Properties is a family company. We are originally from Winnipeg, Manitoba. We moved here in the 70s. My grandfather started though back in Winnipeg in the 60s, and my father, when we moved to Toronto, started acquiring multi-res buildings primarily. And up until probably the late 90s, that was our primary focus. We branched out from there into other kinds of commercial and investment properties and expanded across Canada into Ottawa, Calgary, now we're in BC, and also down into Bahamas and parts of New York City. But multi-res is our primary business and our primary focus.
Mm-hmm.
So I'm excited to hear about our topic today, the state of the market.
Absolutely, absolutely. So if you'd like, fire away.
Sure. So Tony, what are the current market conditions for buyers? Has the lack of inventory perhaps push values beyond what you'd consider acceptable levels?
Well, as far as inventory goes, I mean, in the last 15 years, we've seen a steady rise in the market. A lot of people have sort of taken that rise in a way that they become possibly unsustainable, or maybe values have been overshooting, but I really don't believe that. I think multi-residential real estate was so undervalued after the downturn of the early 90s that we finally have actually caught up with where the true intrinsic value of these assets should be. So, are we overshooting out there as far as prices or cap rates go? I don't think so, because cap rates alone aren't really a good determination of value, and we have to look at take a holistic approach, if you will, to look at prices per unit and even prices per square foot these days.
Definitely. Would you consider buyers today better capitalized than in the past when they're buying?
Oh, absolutely. Properties? I mean, when I got into this business back in the late 90s, I mean, most of the buyers were small private players. I mean, we had the larger families and private individuals that were in there before, but for the most part, multi-residential real estate has become much more corporate, if you will, with the introduction of some of the first REITs in the late 90s that have today become some of the larger players out there. So definitely much better capitalized than they were back then, and much easier to get a deal done, if you will, as opposed to the bad old days of the late 90s.
So with the hot market, bidding wars become the new norm in major areas?
Absolutely. If you look at the major centers across Canada, particularly Vancouver and Toronto, it's basic economics at play. You have a very scarce resource that's in very high demand, and that's going to, in turn, translate into higher prices. In order to prepare for a bidding war, I think it's important for a purchaser to look at the building and not strictly focus on things such as cap rates. Cap rates really don't tell the whole story behind a building. I mean, a cap rate is really just a snapshot, if you will, of the current performance of the building. If there is some good upside there, or some renovations that could take place that could get rents up, I mean, that really changes your whole formula for determining that cap rate and getting your net operating income up. So again, when looking at a lot of these assets, even though you're looking at an aggressive number based on a cap rate, it really doesn't tell the whole story. I think you have to look at both prices per unit and in some cases prices per square foot.
You got to look at the big picture, I guess.
Absolutely.
The whole picture.
Absolutely.
Cool.
So Jason, I got a couple of questions for you as well. I mean, outside of price, what are the most appealing factors when looking at a potential acquisition from a buying perspective?
Sure. Well, it's got to be the location, and for us, the location really means the access to amenities, and especially in a place like Toronto or downtown Toronto. So I'm looking specifically at access to transportation, high-speed transportation where people can get to and from employment quickly. So that'd be the most important factor. Location, of course, is a general term, and also access to things like grocery stores and other shopping facilities, sort of curb appeal to the building, being able to walk around and get a good feel from it. So, but it's definitely, a lot of things can be replaced, but the location is irreplaceable. Mm-hmm. So Tony, where's the majority of the buying traffic coming from these days? You mentioned that there's more institutional buyers. Would you say they make up a lot of the market?
The institutional players are certainly a sizable portion of the purchasing market these days. But again, with the increase in prices recently, We've seen the REITs maybe get pushed off a little to the side in certain deals in particular. The REITs just can't get as aggressive as a lot of the private buyers can. I mean, the REITs have unit holders and boards to answer to, so they have to be very careful in terms of
keep their distributions going, right?
Absolutely, and I mean, and even for an opportunistic investment, I mean, those purchases have to be accretive from day one. So it's not like they could be looking at taking something on and taking a loss at the beginning. That just doesn't work for them. But another factor that we've seen, certainly in the last couple of years, has been the introduction of more international buyers. Achilles being probably one of the larger ones out there, and they've been growing and getting very aggressive on pricing, and that's certainly mixed things up in the market.
An impressive buyer for sure.
Absolutely. So, Jason, does overpaying? I mean, we talk about aggressive pricing. Now, does overpaying for a building make sense? And if so, what justifies that?
Thanks, Tony. I mean, no one really wants to overpay, but I suppose if you're looking at it as far as a larger plan, for example, an assembly for a new development intensification of the site, that clearly would justify being aggressive on pricing. And then also, if you want to add to a specific location or area that you're already in, I suppose you could justify that. But frankly, the inflated or higher value paradigm we're in today has definitely made it very difficult for private buyers to find quality product to add to their portfolio. So there's definitely a challenge there.
No, I agree. Now, when you're performing a walkthrough in a potential acquisition, what are the most important building elements that you look to inspect? And at what stage is it appropriate to possibly bring in your own consulting engineers to review things?
Sure. So when we're going through a building, my eyes are usually gravitating to the interiors of the suites, because that's where we're going to get in and do a lot of work on our own and use our own kind of brand of renovation and improvement. So I'm going to rely a lot on the consultants for things like the underground garages and the plumbing conditions. But I'm definitely eyeballing if there are any leaks anywhere, if there's any rusting, if the rebar is showing in the balcony. Things of that nature are automatic. But I'm really focusing on the suites, because that's where we see the opportunity to add the most value and do it our particular way. And I don't have to rely on anyone in that respect. But if you identify any problems, we're always relying on the consultants in our due diligence.
Mm-hmm. And as far as the reports go, I mean, does it usually, unless it's a major component, I mean, does it usually result in some sort of a price adjustment for major deficiencies, or would you sort of, absorb it and move on with the deal?
It really depends on the transaction. I guess if it was identified in the due diligence materials up front that there'd be a major underground garage restoration cost, clearly it's priced in. But if it's something that comes out of the woodwork, it becomes a closing item. But I found in my experience, and I'm sure my father would echo it in his many-year experience in this business, that if you have a willing buyer and seller, they can come together and make a deal. And it doesn't matter what's in the agreement or anything else. If those two parties are thinking the same way, you've got a deal. So. Okay, Tony, tell me, what makes a strong offer today? What kind of down payment, financing terms, closing conditions would a seller look for today?
Well, strong offer today is obviously an all-cash offer with a very big number on it, no doubt. But what we're finding, in particular with larger deals, is we're getting some deal fatigue, if you will, once things tend to drag out for more than 30 days on the due diligence side. 30 days we feel is an adequate amount of time to get financing in place, and it just helps to try and condense that as much as you can. I would prefer to see due diligence periods of no more than 15 days. I know that in a lot of cases that's just not possible. However, if some pre-work has been done up front by the seller, it's easier to get that into that condensed period that we like. As far as down payments go, a down payment of equal to about 5% of the total purchase price should be adequate. I know in a lot of cases on bigger deals that's not always possible, but as close to 5% as you can get. But for the most part, it's really come down to due diligence. The longer I find the period runs, the more chance there is of complications, second thoughts, if you will. So we want to try and get that as tight as possible.
You've seen a lot of deals recently. Any big turnoffs from a seller that they don't want to see in an offer?
Well, again, it's these long due diligence periods, and of course, even finance. I mean, in the last couple of months, I mean, I've seen a lot of sellers look at financing conditions, saying, "Well, we're in a tough market. Why does this person need financing? I thought he told us he was well capitalized and he was an all cash buyer, and here he is coming back with a finance condition." But you can't. I mean, you can't help that to say that. Well, everyone's just going to come up with a suitcase full of cash to give to you. I mean, it's everyone's always going to use debt to finalize the deal, regardless. So, but aside from that, due diligence has become the main driver in a deal. If you can keep it tight, you're guaranteed to get that deal to run much more smoothly.
So it's really inconsistencies that would tick off.
Very much so, yeah. Very much so. And of course, there's always the question of the unknown. I mean, if the buyer has no real track record or hasn't made an acquisition in the last 10 years, that certainly raises some red flags with a lot of sellers.
So with the sort of scarcity of product that you've identified and we're all familiar with, has it given you any thought? Have you given any thought to the opportunity of finding development sites as well, especially in the GTA core, your primary market?
Well, I mean, development has become very much a niche type of play for certain developers out there. I mean, certainly with the condo developers within the city of Toronto and Vancouver, it makes sense because they have that really robust construction and development background. I wouldn't recommend somebody who doesn't have any type of development or construction background to sort of take that approach, because there are a lot of unknowns when you get into construction. Construction's become very much, or development, if you will, has become very much politicized as well. I mean, you have to deal with not only the planning and development departments, but there's also council, city management, and then of course there's obviously the opposition that may take place in a certain neighborhood.
A lot of special interest groups, heritage preservation.
Sure. And you have to have the experience to work through a lot of that. And if you don't, a lot of people can just get frustrated and sort of drop everything and move on. But some of the more experienced players out there can work with that and sort of sail through that, if you will. Mm-hmm. Let me ask you something about the current market conditions. I mean, have they affected cap rates, and have they extended your holding periods at all?
Well, the cap rate, I was always taught, is really a function of a risk premium over a riskless asset like a treasury bond or government bond. And I think that I was always under the assumptions that a fair cap rate for an investment product like a multi-res building was maybe a couple hundred points over that. And it's really shrunk a lot in recent years. And whether that's a function of there being an associated lower risk associated with multi-res buildings or some sort of future inflationary bump you're going to achieve on your rents down the road, I'm not sure, but it clearly has caused traditional multi-res buyers such as ourselves and other families in this asset class to contemplate other ways of deploying our capital, whether it's back into the building in the form of renovations or intensifying sites that have the opportunity for high-rise construction development projects. It is a cause for concern and for an opportunity to really to reflect on what's the goal here, because there was a period where you could add multi-res to your portfolio in a positive leverage scenario, but today with kind of a reasonable amortization schedule and what cap rates are today and what real operating costs are today, a lot of which isn't necessarily so apparent from the materials that we find when we're reviewing opportunities in multi-res. It can be a negative cash flow scenario. So people today are often thinking, maybe there's another way to deploy our assets.
Sure. And generally at a 100 basis or a 200 basis point spread over the Bank of Canada bonds doesn't leave much for a yield in a lot of cases. Now, getting to, we discussed construction, so I wanted to ask you, what are your thoughts on developing new apartment buildings? Well,
actually, we undertook to develop our first high-rise condominium project as a first party recently in a partnership with Tridel. Mm-hmm. We launched a 420-unit condominium at Yonge and Eglinton on 101 Erskine Avenue, and it's gone quite well. We feel Tridel is an excellent partner, and they've lived up to their end of the bargain so far by delivering strong sales. We hope to start construction in the fall. Mm-hmm. And I think for multi-res people like ourselves, who are multi-res owners at our core, having an experienced partner that has the ability and the diversity in their expertise to handle this kind of project. It's quite intricate with the essentially the way the two projects come together. The existing building there on the surplus land adjacent to it, there's a really nice walkway that goes through it, and an open space parkland that we've designed. So I think high-rise condominium development on surplus land for existing multi-res is a great option to consider, either on your own or with a partner. But you got to be careful, as you suggested earlier, because there's a lot of perils in new construction. And let's face it, the prices are really outrageous these days with all the land transfer and levies and development charges and all the other Section 37 benefits.
Recently.
Yeah, it only goes one way, and you got to be real careful. I think ideally we'd love to add new multi-res to our portfolio, and we're exploring that in a couple sites where I think it might work. But it's something you got to be very careful with because of the enormous debt levels you'd be taking on in a new high-rise development where you don't have that exit strategy of condominium.
Sure.
You're committed to rental.
And you've got lease-up delays and everything else. I mean, that does take time to lease up an empty building of 200 to 300 units.
Absolutely. Who knows where the absorption really is going to fall? Because there have been anecdotally a lot of very high new condo rental leases done in the last couple of years in the downtown core. We all are familiar with that. But ultimately, can you lease a 300-400 unit building or even a 200 unit building quickly and at those numbers and with low vacancy and everything else? Remains to be seen. But there've certainly been some institutional players who've done it recently, and I applaud them. And we'll see how deep that market is. It is a buzzword today in the industry, but I'm not as confident as a private guy that that's the best way to deploy my money in those sort of deals. I've heard numbers thrown around like 6 cap pro formas, and we just don't. We do a lot of retail development. We don't undertake developments for that kind of return.
Sure. Well, time will tell, I guess.
For sure.
Absolutely. Jason, thank you very much for taking some time out to come see us today, and good luck.
Same to you.
The RHB Insider Network is an RHB Inc. production, publishers of RHB Magazine, and the producers of RHB Newsreel.